My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Do my friends just trying to make a little money. My job is not just entertainment, but put days like today into some sort of context. So call me 1-800-743-CNBC. Tweet me, Jim Cramer. Look, it was a heck of a lot easier to own the stock of Nvidia when hardly anyone knew about it. Once you get this big to the point where you become the entire fulcrum of the stock market, you're going to have a target on your back, and that is exactly what I think happened tonight to the stock after Nvidia reported a fine and dandy set of numbers, because fine and dandy is no longer enough with this incredible company. Now, we know the pre-quarter jitters of National Nvidia Day weighed on the averages. Dow declining 159 points was worse. S&P losing 0.6%, NASDAQ tumbling 1.12%. And now with the stock sinking after hours, we could be in for a hangover from what they're already calling Nvidia's buzzkill quarter. But they happen to be like the people having an Nvidia watch party. Yes, there was one. There's nothing to celebrate here. Move on. All right, let me just inject a note of sanity to pinprick all the insanity about this amazing company. Nvidia just reported a stupendous quarter. 122% revenue growth, for heaven's sake. Adjusted earnings per share increased 152%. Company announces a $50 billion buyback. $50 billion here, $50 billion there. Come on. Yet it's still sinking in after hours because the expectations got out of hand. Worse, Nvidia has become overly important to the fate of the entire stock market. That even I, who once named my dog after this company, think it's all gotten to be too much. We know that artificial intelligence is the way of the future. We also know that Nvidia is the best play on artificial intelligence. In the end, though, Nvidia has become an albatross around the market's neck because no one stock can be a proxy for the future of the S&P 500. Yet that's exactly what happened as Nvidia romped from around $500 billion in market cap just 18 months ago to more than $3 trillion now. Maybe after tonight, it will shed that millstone, that albatross. You know what? That would be a godsend for all of us. Why is the Nvidia apotheosis wrong? Because business is a funny thing. Today, before Nvidia reported, we learned that a client of the firm, an important one, Supermicro, will delay a key SEC filing because it needs more time. Now, this is something that's always going to be viewed as negative, especially because a short seller dropped a devastating series of allegations against the Supermicro just the day before. This is Supermicro we're talking about, not Nvidia. But is it also negative for Nvidia? Do you think any of the people who are new to the stock bothered to ask whether Supermicro's delay has anything to do with Nvidia's future? It was strictly shoot first and then ask questions later. What was truly incredible, though, was how the contagion rapidly spread to the rest of the tech world. All the semis that I follow, almost every company involved with enterprise software, thank heaven, Salesforce reported a good number tonight. Now, the quarter itself, the actual Nvidia quarter that was reported, by that point, it felt like insult added to injury when there was no injury to Nvidia. The company will muddle through and recharge. At its next iteration, Blackwell goes full bore, and we see renewed expectations. I hope they don't get excessive like they were tonight. And you know what? I just hope this is it for National Nvidia Day. Can we just call that a day? All right, what is the solution to hanging on every Nvidia word? It's simple. It's as plain as the nose on your face, or at least a letter purloined and posted right in front of you. The solution is perhaps the most boring part of investing. I'm talking about diversifying away from nothing but tech. We often say diversification is the only free lunch in this business, but the reality is diversification is a total drag. Why would anyone ever want to own a stock of a bank or a defense company or packaged food place, especially with the GOP-1s? On most days, these stocks are just ballast or a bunch of disparate entries that are unconnected to Nvidia or Supermicro or even Microsoft or Amazon, to name two key partners of Nvidia that are also sinking tonight. And on days like today, they don't do all that good a job of buffering the tech weakness. That's okay, though. There are going to be days where all you want to do is lose less than the market. That, plus the cash you have on the sidelines, are not necessarily meant to help you make money regularly. They're meant for something bigger. They exist to keep you in the game when the hottest stocks turn cold, like Nvidia has done. They prevent you from being so disillusioned, so bummed, that you throw up your hands and say, I can't take it anymore. Something that you might easily do if you only own the stock du jour, which sadly fits the bill of this unbelievably good company that is Nvidia. As someone who runs a diversified portfolio for my charitable trust, I spent the better part of the rally coming into today raising cash, as I said we do, after we saw the work of the wonderful, incredible market historian Larry Williams, who's retiring. He said this period should be one of the worst for stocks, so we started ringing the register. He said that this would be a period that would be really horrible for Nvidia, so we didn't encourage people to buy it. It was so hard to part with anything as the market went higher. It was hard not to say go buy Nvidia every day. But our discipline says to sell a market that's overbought like this one, and our discipline said do not tell people to buy Nvidia ahead of the quarter. It's just too steaming. Our discipline says to own stocks like Stanley Black & Decker, which is featured positively in today's Wall Street Journal, or Wells Fargo, a bank stock that's been riding the wave of lower rates. It's why the trust owns Costco, which has nothing whatsoever to do with tech, yet has been an outstanding performer. It's why we constantly proselytize for Eli Lilly, because we believe this drug company can be the first non-tech stock to hit $1 trillion valuation. Costco is levered to its membership dues. Lilly's all about the revolutionary weight loss and diabetes drug. More on that later. Now, in the end, there's no denying that if you own any stocks, especially tech stocks, that were smacked around in the wake of National Nvidia Day, sell. Hence, you need to have some cash on the sidelines. But days like today are the price you have to pay to try to get rich in the stock market. And make no mistake, if you own Nvidia for the last several years, well, you are already well on your way, or you should be there. The bottom line, I always tell you to own Nvidia, not to trade it. I am not going back on that. But I don't think that's possible unless you have a diversified portfolio as well as some cash on the sidelines so you can handle a stock like Nvidia. They allow you to stick with Nvidia even when it's getting clobbered like it is tonight. They allow you to stay sane and still own stocks. They don't block the exits. They keep them open for an orderly departure for a correction after a big run. Sometimes that's enough to help you absorb the pain from days like today and perhaps tomorrow. Even on National Nvidia Day, what do? We take questions. Alex in New York. Alex.
Booyah, Jim. Pleasure to be on your show. Longtime fan. Just wanted to ask you what you think on Berkshire Hathaway.
Berkshire Hathaway is what I call an up stock. It's been that way since Leon Cooperman first told me about it in 1983 and 84, and it remains an up stock even today. Okay, look, if you stick to diversification and have some cash on the sidelines, then it's much easier to own red-hot stocks like Nvidia, and you can absorb the pain that was felt across the tech sector today. Mad Money tonight. Salesforce is on the move after earnings. I'm sitting down with CEO Mark Benioff, fresh off its report, and that's a tech company that did well, but it came in cold. Then what do we do with the recent batch of retail earnings signal? What are they signaling for you, the consumer? I'm investigating. And Affirm just reported after the close tonight. I'm crunching the numbers for that red-hot beacon of a buy now, pay later stock. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Okay, all right, enough with National Nvidia Day. They weren't the only company that reported tonight. We got results from Salesforce, the king of the enterprise software space, a group that has been struggling for months thanks to constrained tech budgets, clients trying to figure out what they actually need in a world full of generative artificial intelligence. Last time Salesforce reported, the stock just got crushed. And while it's been rebounding since then, we needed to see some really good numbers to validate that move. Tonight, that's exactly what we got. A fantastic quarter. Management raising their earnings guidance, beating on cash flow, revenue margins, a great prelude to Dreamforce in just a few weeks. But don't take it from me. Let's check in with Mark Benioff, the co-founder, chair, and CEO of Salesforce, to learn more. Mr. Benioff, welcome back to Mad Money. Mark, you just reported an amazing quarter. Now, there's been a transformation going on at Salesforce, which has been able to drop a lot of money to the bottom line. But at the same time, last quarter, you yourself said that there was some weakness. You felt that the environment couldn't be overcome. What has changed? Because this number indicates that either the environment's gotten better or you've gotten better or both.
Jim, it's great to be with you again, and I'm so thrilled to deliver this fantastic quarter. You can see the numbers. It's just incredible what our team has done, and in concert really with our customers. But Jim, I have to tell you, I've never been more excited about Salesforce and what's happening with the technology industry, and we're super excited to get you to Dreamforce, because you're going to see something that we didn't even get to talk about a quarter ago, which is Agentforce, and how we're transforming our customers with this incredible new artificial intelligence.
Okay, well, tell us how big companies are using Agentforce. I know already it's being employed. What's it doing for what's it doing for ADP, for instance, the largest payroll processor?
Oh, that's a great story. Well, Jim, we have deployed Agentforce now to so many of our customers, and we're so excited because what we're helping them to do is to deliver a level of automation with their customer service or with their sales that they've never seen before. And ADP is a great example. And Jim, we already run ADP's sales organization, but also their customer service organization. But now, Jim, when consumers call into ADP, they can actually talk to agents, not just humans. And that agents are resolving more than 90% of all of ADP's inquiries. That is very exciting. And we've seen that same result in many of our customers. In fact, at another amazing customer that you know very well, OpenTable, well, they have 160 million consumers that are working with their service. And their deployment of Agentforce, well, it's also resolving more than 90% of their customer inquiries. And it's directly talking to those consumers as they have issues. So you not only have automation of the sales organization and the service organization, but now you have an extension of these organizations with agents. And why that's exciting, Jim, is this. For the last 2.5 decades, what Salesforce has done is helped our customers build a great sales force, a great service force, a great marketing force, even a great commerce force. And now we're helping our customers build an agent force. And this is a breakthrough thought.
All right. So this morning, my colleague David Faber, who appreciates your work greatly, was talking about Klarna, which is a very good company. I've worked with them.
I love David, by the way.
Who doesn't? Bell loves him, but that happens to be his mother. And we were talking about Klarna, and he mentioned, Klarna's now cutting off Salesforce. They don't need Salesforce. They're trying to figure out exactly what to do with AI. To me, that seemed like I'd like to know more. Let's put it that way, because what to do with AI may mean using Salesforce to do better with it.
Well, I think what customers are doing is transforming, changing how they use information technology. That's a great story. In fact, you probably saw on LinkedIn, Jim, that Klarna just posted how they're using Slack to deliver a whole operating system to run their company in a whole new way, using our new artificial intelligence capability that is manifested through Slack. Now, in the quarter, Jim, we delivered, since we're talking about AI, 25 trillion, that's trillion with a T, Einstein transactions, which is this AI capability that's managing the agents and managing the predictive and managing the Slack and all of these capabilities to all of our customers. And we've powered more than 1 trillion workflows. That is accompanied by 250 petabytes of data. So that's across all of our customers, hundreds of thousands of customers. Each and every one of those customers is doing 3 things, Jim. One is they're automating every customer touch point. That's automating the sales organization and service and marketing and commerce and all those things that we've talked about for years as customer 360, right? The second thing these customers are doing is building a data cloud, because you need this amalgamated data to deliver this excellent, accurate artificial intelligence capability. And the third piece is they're delivering agents. And these agents are the next generation of artificial intelligence, where you're able to go out and talk directly to your customers with AI. So it's the AI talking to the customer themselves. So the applications, automating your humans, the data cloud, amalgamating your data, and then the agents who are talking directly to your customers.
Okay, I want more use cases. For instance, a friend of mine put together Wyndham. Okay, just a fantastic company, the largest hotel chain in the world. And I'd like to know exactly what you're doing for Wyndham, because they are an excellent company. Another great story
who's using Agentforce to talk to customers directly about what they are doing with their products. And of course, you've made your hotel reservation, you've got questions, you're getting ready to come in. You can talk to a human being, or you can talk in many cases directly to an agent. And why that is important, Jim, is because we're able to take the ebb and flow of customer demand, and we're able to kind of meet that as the customer needs it. Let me give you another great example with Wiley, the textbook company, who's also using Agentforce. They have incredible seasonal demand right now when kids are going back to school. And they're able to use Agentforce to directly expand their customer service capability. And instead of hiring or trying to surge their customer service organization and train all these folks, which, by the way, is what they've done in the past, now they're able to just use Agentforce to take that additional capacity.
That makes so much sense. So no, I get it. So rather than hire a full-scale, huge suite of people that is only used during 3 months, you have these agents that are used during 3 months, and you don't have to do that. You don't have to let people go hire. You don't have to train people and not use them. No more what we used to call at Goldman Sachs dead wood. Terrible
Jim,
term.
It's an amazing moment where humans with agents are driving customer success. Jim, humans aren't going away. No. We're automating all these customer touch points with our apps. We're building the data, and now we're deploying agents. This is the 3 levels of AI. And Jim, customers have done a lot of science experiments with AI over the last 2 years. I've never seen so much money wasted by customers trying to build their own AI. It's crazy what has happened. And some of these huge companies like Microsoft have told those customers to go train their own models and build their own models and then retrain their own models. Jim, we've built all that right into our platform. So you can build your model and train your model and fine-tune your model in our platform. You don't have to go do that to some hyperscaler. And Jim, inside that platform then, of course, you're automating your whole company, and now you're able to deploy automatically all those agents. It's all one piece of code. So your sales, your service, your marketing, your commerce, your analytics, your Slack, all of this is in Salesforce, your data, and now all your agents. It's an incredible new thought in how to automate a company in 3 tiers.
Now, you did say that humans aren't going away, but one is. Amy Weaver, whom you introduced me to, does excellent work as CFO. When we always have to ask when the CFO leaves, why, what's happening, and do you have a replacement?
Jim, it has been an amazing story with Amy Weaver, who came in more than a decade ago as our general counsel. And as you know, 4 years ago, when Mark Hawkins, who was our 4th CFO, decided to retire, she decided to come in and kind of take 3 or 4 years. It's been incredible transformation that she's led to be our CFO and to move from our general counsel to be our CFO. And she's decided at the end of the fiscal year, which is next February, in 2025, she's going to step down. She'll still stay with the company for more than a year or more after that to onboard the new CFO. And yes, Jim, we've hired Heidrick and Struggles, incredible person, Jeff Sanders, who we've worked with for 25 years to find our new CFO. So, this is a great opportunity for a lot of folks that we're talking to, internal candidates and external candidates who want to be Salesforce's 6th CFO. This is that moment.
Understood. A great honor to be one of those. I understand. Non-GAAP operating margin, a stellar 33.7, up 210 basis points. That makes me feel that maybe the IT environment has gotten a little bit better.
Jim, I think we're just in an incredible new environment.
Okay.
And I think that the technology is like nothing I've ever seen before. And every company understands, because they're using these new AI models at home or personally. But now we can really show how they're going to get value for their companies to do 4 things. We've talked about this. So now we're able to manifest it, and we have these amazing stories like we just talked about with OpenTable and ADP or with Wiley or with Windows. It's amazing what's going on.
But do people understand this? I mean, maybe they have to come out to Dreamforce, because I feel like some people say, wait a second, this is technology. We don't know how to use it. It's costing us a fortune. Like you said, I mean, does it just have to be a story told in order to realize the savings rather than realize the expenses?
Jim, at Dreamforce, we are going to light up for our customers. Every single one who comes to Dreamforce, I'm going to turn agents on for them. So you come to Dreamforce, you want to know about how to automate all your customer touch points, we're going to do that. You're going to want to know how to amalgamate all your data and federate all your data clouds into our data cloud, we're going to do that. And now for the first time, Jim, we are going to turn agents on, sales agents and service agents. And remember, Jim, we're also building the agents for Workday, for HR as well. We were just on with Carl Eschenbach. So Agentforce is becoming this incredible new platform that you can even build your own agents.
Well, that is what we're
going to do for customers, and we're going to do it for them there. So we're going to have thousands of companies turned on at Dreamforce with Agentforce. And that is going to be a remarkable thing. And what they're going to do is they're going to be able to connect with their customers in a whole new way. And we've got the stories that are so inspiring with what these customers are already doing. And we're working. I'll just tell you one thing. I'll give you a little bit
it's just you and me at this point.
Jim, you got to listen to this. This is amazing. The largest healthcare company in the United States, who has the largest Epic database,
Kaiser,
with 20 million consumers, is resolving more than 90% of all of their patient inquiries right now with Agentforce.
That's incredible.
That is
incredible.
Remarkable.
All right, well, with that, we're going to have to leave it. We won't be going out the Dreamforce if you give it all away. So let's say right here, this is a Mark Benioff who's a bullion, as they say.
I am so excited about the future.
That.
Incredible.
September 17 to 19, I will see you, and I'll also see Tiny Dancer.
Jim, I'll see you there.
Thank you, Mark Benioff.
Can't wait to have you. It's all the best.
Hey, Money's back after the break.
Coming up, Cramer is no secret shopper. He's on the record and hunting for retail deals. Next.
Now the retail earnings season is in full swing. We're seeing a real difference between the haves and the have-nots. I mean, Walmart and Target turned in terrific numbers. So did TJX, the off-price kingpin that the Caliber Trust owns. These are all chains that offer consumers great value. But as we've started hearing from more small and mid-sized retailers, Wall Street's been a little more jaded. Not all the smaller chains saw their stocks get hit, but most did. And their declines tend to be much larger than the few gains from the group. Of course, the market's initial reaction is often wrong. And people make a lot of mistakes during earnings season, as I always tell you. That's why tonight, we're going to walk through the half dozen of the retailers that just reported, see whether the moves in the stocks make sense. Maybe they need a little adjustment. Let's start with the two retailers that saw their stocks rally in response to earnings today. Surprisingly, they're both department stores. Remember those? Nordstrom and Kohl's. Last night, Nordstrom delivered better than expected same-store sales and a substantial earnings beat, with management raising its full-year earnings forecast. Now, you might not think an expensive department chain would work here, but Nordstrom's strength came from its off-price Nordstrom Rack business, with 269 stores around the country. As for the core department store, it got a boost from the company's annual anniversary sale. More of that sale fell during the second quarter of the year, which really bolstered the numbers, even as it will hurt the current quarter. Look, overall, I think Nordstrom should get credit for leaning into value. That's what the customer needs and wants. Stock rallied over 4% today, but while that's justifiable, I'm not willing to stick my neck out. I have to tell you, though, I think that this rack is worth more than the whole chain, and that may be the conundrum people feel. How about Kohl's, the other retailer that gained ground today in response to earnings? These guys are trying to mount a comeback under the leadership of new CEO Tom Kingsbury. He's a retail whiz, formerly at Burlington Stores. Wow, what he did with that one. But I think the stock's mild bounce today was more a reflection of the fact that Kohl's was down 34% from its April highs as of last night's close. Although I like its total embrace of the fast-growing Sephora business, which is embedded in over 900 Kohl's locations. At the end of the day, this was a mixed quarter for the department store chain. Kohl's saw a 5.1% decline in same-store sales, worse than expected, and a significant revenue miss. Kingsbury said, and I quote, "Customers exhibited more discretion in their spending, which pressured our sales," end quote, bad. Of course, there were pockets of strength, like the aforementioned Sephora, along with home decor, that was nice, and gift and impulse purchases. Wow, impulse at Kohl's. And while their sales were soft, Kohl's certainly executed well, delivering a 15-cent earnings beat off a 44-cent basis. It's been a while since we've seen one of those from Kohl's. Management also raised the full-year earnings forecast dramatically, even as it lowered its revenue outlook. Hey, I'll take it. Long story short, Kohl's new management's muddling through a weak environment pretty admirably, but I can't embrace the turnaround until we see some improvement on the sales front. I love that Sephora business, though. How about today's retail losers? Let's start with what had been one of the hottest stocks of the past few years. Abercrombie & Fitch, A&F. Stock plunged 17% today. Despite reporting what I thought was a pretty darn good, solid set of numbers. Abercrombie had 18% same-store sales growth, higher than expected. 21% revenue growth. They earned $250 per share. Street was only looking for $222. That's 127% earnings growth year over year. Hey, kind of like Nvidia. The company even raised its full-year sales forecast aggressively, also boosted their operating margin guidance. So what was the problem then? Well, the sellers seemed to focus on three words from an otherwise positive quote from Abercrombie's let's just say, really, the CEO has the place so well run, Fran Horowitz. And she wrote the words increasingly uncertain environment into the call. And And while the updated full-year forecast was terrific, the forecast for the current quarter represented a deceleration from the results they just reported. Hey, look, frankly, I'm grasping at straws here. They're the only explanations I can find for this just guillotining. And I don't think it's convincing. Abercrombie's giving conservative quarterly guidance in a tough operating environment. And with football season on the horizon, let's just say I take the over on the third quarter outlook. DraftKings has nothing on me. In the end, the stock rallied 16% in the 3 weeks before the quarter. Today, it basically just gave back those gains. I say buy the pullback in one of the hottest retail concepts out there that's very well run. I think it'll bounce. It was overly punished. Second down retailer hits too close to home. I'm talking about Foot Locker. As a former holding of the charitable trust we bailed on in June. Absolute numbers here were not as strong as Abercrombie's. Foot Locker's still firmly in turnaround mode under new CEO Mary Dillon. I should say relatively new, but they were still better than expected across the board. I actually liked the quarter. After 5 quarters of same-store sales shrinkage, Foot Locker returned to growth, up 2.6%, handling beating expectations. That should have been enough to keep the stock a little bit higher. Gross margins expanded. That should have been enough. Inventories decreased by 10%. That should have been enough. And they only lost 5 cents per share when Wall Street expected a 7-cent loss. But they still lost money. How come the stock lost 10%? Well, first, the stock came in the quarter again, like some of these others, very hot, up 45% for the last time the company reported in May. Second, I think the sellers are basically saying that they don't believe Foot Locker can make its full-year forecast because they'll need a couple of strong quarters to make the numbers, especially on the earnings front. But having listened to the conference call, management laid out some major positives. Most important of all, Foot Locker's relationship with Nike seems to have improved substantially. Nike needs them more than Nike thought. That's very important. It ain't just all DTC. At the end of the day, Foot Locker's a turnaround story that's going to take at least a couple more quarters to unfold, but it's going to unfold. Stock may have gotten ahead of itself over the summer, one reason why we sold it for the charitable trust. But if you have a longer-term view, I think this is a buyable dip. PVH got hit today. Parent company of Calvin Klein and Tommy Hilfiger saw its stock slide more than 5%. Company reported a solid set of results last night, slightly higher than expected sales, paired with a monster 72-cent earnings beat off a 229 basis. I mean, the second quarter was good. Problem here is that the guidance for the current quarter was completely mystifying and outright bad for that matter. They expect sales to be down 6 to 7%. That's worse than we thought. And they'll earn $2.50. Analysts were looking for $3.12. I mean, that's brutal. Now, PVH typically guides conservatively, but this was much more below the expectations than usual. And given that the stock's been more or less flat over the past 12 years, with no strategic plan that I really have any confidence in, I can't blame anyone for selling it. It's starting to really bother me. Finally, Bath & Body Works, the struggling mall retailer, reported another bad quarter today. Shares sunk 7%. Comparable sales missed, revenues missed, and the only earnings came in just a penny better than expected, which was still down 7.5% year over year. Worse, management guidance for the current quarter was horrific, and they slashed their full-year forecast. CEO Jennifer Boswell says that, quote, they're taking a prudent approach, end quote, to their outlook by cutting numbers. So I'll take the prudent approach and tell you, please don't go near Bed Bath. You can go to Bath & Body Works. It smells nice. You walk by, it smells. I always like, I mean, can you smell it? I smell it right now. I mean, like, you can just reflect on it. It's like International Flavors and Fragrances right here. Or maybe it's here in the Vegas Nerve. Bottom line, looking back at the last 24 hours in retail, Nordstrom and Kohl's deserved a rally today, but they're both very much in show-me mode, especially Kohl's. Abercrombie and Foot Locker got hit way too hard. I really like the Foot Locker, Abercrombie, great buying opportunity. As for PVH, Bath & Body Works, all I can say is, as the man who is behind so much of the greatness of the show, Cliff Mason, said to say, all I can say is if you lie down with dogs, you wake up with fleas. Okay, how about Mike in Washington? Mike.
Booyah, Jimmy, chill.
Yeah, I'm chilling. I chilled all day today because it was National Nvidia Day. What's happening?
What are your thoughts on Rivian stock?
I think Rivian's a great long-term stock. Why? Because the actual product is so fabulous that I would be the last thing I want to do is write these guys off now that they have a deep-pocketed partner. Does that mean you should own the stock? No. It means that you shouldn't sell the stock necessarily, but it means the company's sticking around, and that's what really matters. Okay, listen, Nordstrom and Kohl's deserve to rally today. Abercrombie and Foot Locker didn't deserve to drop so much on good numbers. But as for PVH and Bath & Body Works, why don't we just steer clear? You can go buy some Calvin Klein, Tommy Hilfiger. That's fine with me. I'm not going to hurt you. Much more Mad Money ahead, including my exclusive with the CEO of Affirm, fresh off the company's report. Then, what is it the maker of Twinkies signaling about the impact of GLP-1 weight loss drugs? I'm unpacking the latest in the packaged food stock space following J.M. Smucker's earnings. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. future look like for Affirm Holdings, the financial technology company that's the king of buy now, pay later? Now, you might think they're struggling, right, in a world where the consumer's gotten more picky about discretionary spending, unemployment rate ticking up a little bit. But then again, they're going to get a huge boost when the Fed starts cutting rates. And hey, you know what? They're already doing pretty darn well without the Fed's help. When Affirm reported after the close tonight, they blew away the estimates. Better than expected gross merchandise value, that's a key metric. Great take rate, operating income, and basically every other key metric looking terrific. Even better, management gave tremendous guidance for both the current quarter and the full fiscal year. No wonder the stock's flying after hours. It should be. But can it keep running? Let's dig deeper with Max Levchin, the founder and chairman and CEO of Affirm, find out more about what happened with this quarter in the future. Mr. Levchin, welcome back to Mad Money.
Thank you. Good to be here.
There are a host of narratives involved with this quarter, all of them incredibly positive. I'd like to start with the fact that the sheer volume through your network was rather extraordinary at a time when a lot of people are saying that the consumer's weaker. So how do we explain this?
Well, I think the honest answer is we're still small. And so even if you think the world is not growing as quickly as it perhaps should, we are growing extraordinarily well. You can see that we clipped 30% very nicely. We grew revenue even faster than that. And people like Affirm. They enjoy using it.
Well, I would also point out that there are a lot of people who felt that you won't be profitable for a very long time. I think it's safe to say that you made great strides in profitability this quarter.
That's right. We did. And we're on the record now. GAAP profitability is next. That's what we're coming after.
Well, that's how stock goes up big. And I know that you've wanted that. You've certainly always been very candid on the show that you want to give everybody credit who can get credit and deserves credit and yet still make money for shareholders. What I thought was, for me, the most enchanting thing was the credit quality. 30-day delinquencies holding in, even though you are supposed to be lending to people that maybe other banks wouldn't lend to.
That's right. And, I always want to repeat that credit outcomes for us is a policy decision. The numbers you see are not and are never an accident. We manage credit very carefully. The oft-repeated line here is credit is job number one. We always start with lend when you can and expect to get paid back. Now, the mission is to bring in as many worthy borrowers as we can to help as many merchants sell as much merchandise as we can. So, of course, we're very growth focused, but we're not going to compromise credit, and that's in the numbers right there.
And that is something that the top three brands in the country, commerce platforms, all must embrace, or else they wouldn't bother to handle your business.
That is right. We are rich with extraordinary partnerships.
Now, Apple Pay is something that just started. This is one of those, I think we're all kind of used to it, even though we didn't have it a couple of years ago. What's been your experience at Affirm with Apple Pay?
That's not live yet, but we are so excited to bring it out. We've been working very diligently, and it is coming. We are just thrilled to be included. It is a beautiful product. It's the digital wallet. It's the wallet I use personally, and many of us do. And that is a beautiful experience. Can't wait to bring it to the world.
So when we analyze these banks, we always are gripped by the idea that some do well when rates go lower and some don't. I would presume that your business is a volume business and that therefore as rates go lower, you'll have more volume.
Every time the Federal Reserve makes a rates decision, we are a recipient of that news and we adjust the business to make sure that we play well with that. Rates go up, we have to adjust, and we've shown over the last year plus that we know how to win in a relatively high rate environment. As the rates are expected to come down, we'll certainly benefit over time. It will be a tailwind, but we know how to win under any rate scenario, as I hope we have shown.
Well, that's true. Although you're not MasterCard or Visa, which have no rate scenario risk at all, but you do have a great card, the Affirm card. And can you give us a sense of what's your take about how that's doing?
It's doing really well. It is, I love all my children, but it is my favorite child as far as products go. It's done really well. We see great adoption, great economics, better credit performance than the rest of Affirm. just a great product that people love. And we are still very much at work building new features. We're rolling out some really cool integration with the rest of the Affirm ecosystem, even as we speak. Just saw a really fun product launch this morning that I'm sure we'll talk about next quarter, but it's a great product, and it's obviously growing much faster than the rest of Affirm because we are very hard at work bringing it to as many users as we can, as quickly as we can.
Including overseas. I see that going live in the UK, you think that this is obviously something that is a universal preset?
We certainly think that what we do, the way we do it in particular, no late fees, no deferred interest, no junk, makes a lot of sense for every market. It's not limited to North America. We've been very strong in US and Canada for quite some time. UK is happening this calendar year. Super exciting. That's not where we're going to stop. We have many other geographies in mind. And we think as we roll out our core products to these markets, there's always an opportunity to bring more universal access through things like Affirm Card.
All right, in the time remaining, I have to ask this. You are very involved with Ukraine, which I think is, you and I both believe is a very important cause. Your take on how things are going?
I am most certainly not a geopolitical specialist. As a human, I just wish the killing on all sides would stop. But that said, I am a Ukrainian, and my heart bleeds for what's happening there.
Fair enough. Let's leave it at that. I think it's important to bring that out, if only just because you and I talk about it, and I think other people should know. Why not? You had a great quarter. We also have time to be able to say something good about Ukraine. I want to thank Max Levchin, founder and CEO of Affirm Holdings. Congratulations. You blew it out. Great job.
Thank you.
Yeah, money's back here for free. It is time. It's time for the Light Round Quiz. Remember, that's Rob Pearl. My name is Sammy Stockton with my advice. I'll start down near the course. That we play with him. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. I want to start with David in Maryland. David.
Hi, Jim. How are you? A huge
I'm good. How are you?
to you.
Done your way.
I have to say, we are truly lucky to have a soul such as you in our world.
Thank you.
I was wondering what your thoughts are on the company Serve Robotics.
Okay, we're back in that moment where we're not recommending companies that lose a ton of money because it's just not the right time. Let's go to Mike in Pennsylvania. Mike.
Jim, listen, a couple of months ago, you recommended Builder, BLDR, First Source.
Yes.
I took a position in it. My question is, with the rate cuts already happening, is that price baked in?
No. This stock 15 times earned. This thing can go higher. This is precisely the kind of stock you should be buying at this stage of the cycle. Hold on. Let's go to Ron in Nevada. Ron.
Hey, Jim. Booyah, buddy. Hey, I'm calling about CMG. CMG. I bought it.
I think you're in great shape. Why? Because I am told, and I read a piece which says that they've got this new chicken that is the honey chicken, and I got to tell you, it doesn't sound like junk food to me. It sounds like good food to me, and that's why Chipotle is probably done going down, and I like it. But Brian Nickel, it's a twofer. I like him at Starbucks. I'm not done. Let's go to Fred in Kansas. Fred.
Hey, Jim. Good to talk to you. First-time caller, long-time listener, hopeful.
Sounds good. Okay.
And I'm calling about Vertex Pharmaceutical.
I think Vertex is great. Look, cystic fibrosis franchise is incredible and a terrible disease. But I also like the fact that what they're doing in terms of opiates. Look, this is a great company. No one ever talks about it. We've had them on. I think that they're brilliant. Okay, period, end of story. Let's go to Sam in New York. Sam.
Big booyah to you, Jim.
Done your way. Also, what's up?
Long-time listener, first-time caller, club member.
Sounds good. Oh, thank you.
Love your work. And by the way, I loved your description of the two gentlemen of Verona of Nvidia.
Did you like that? I needed to put some Shakespeare, and that's my father, an English major's favorite moment in that incredible play. And I'm bringing the Bard back. I bring back Bard, the drug company, but it's already gone. It's more of a device company. Go ahead.
Wanted to hear your thoughts on Viking Therapeutics.
Okay, Viking Therapeutics, look, obviously they've got something that's very good against weight gain, but here's the problem. It costs so much money to build the factories, they're going to have to get a takeover to be able to do that. And that, ladies and gentlemen, the conclusion of the Lightning Round!
The Lightning Round is sponsored by Charles Schwab.
Denial is not just a river in Egypt. That's what I think every time the food and beverage companies go out of their way to claim that the GLP-1 weight loss drugs have no impact on their business. The latest is J.M. Smucker, which missed numbers pretty badly this morning with softness in pet food, higher costs in coffee, and a slowdown in sweet snacks. Stock finished down almost $6. Still, they were eager to defend the $5.6 billion acquisition of Hostess Brands last year. Arguably, I think, the worst time in history to get into the Twinkie business. I get the coffee issues. Coffee's been volatile. I sometimes somewhat understand the problems with pet food. But I'm raising my eyebrows at their explanation for the not-so-hot sales from Hostess. Smucker swears by the acquisition. That's awkward enough. But I find their alibi for the weakness in snack food questionable. On the conference call, Chairman and CEO Mark Smucker blamed the macroeconomic environment and a slowdown in the convenience store channel. Smucker went on to warn that consumers, quote, continue to be selective in their spending, a trend that is largely driven by inflationary pressures and diminished discretionary income, end quote, which Smucker says, quote, disproportionately impacts the Hostess brand. I'm not convinced. Are inexpensive convenience store impulse buy sweets really that economically sensitive? More important, I think it's insane that Smucker refused to acknowledge the possible impact of GLP-1 weight loss drugs. Smucker admits that it often gets the questions from the media, and the response is, quote, we look at that very closely, end quote. Apparently, they've got some new data across households and reached the conclusion, and I quote, that there is really no meaningful impact from GLP-1 drugs. Really? When the drugs first hit the market, I thought that this story was overdone. But now that 1 in 8 people take these drugs, and these are for people who are over-indexed and eating this stuff, I think the impact will be pretty harsh for those who purvey what we call junk food. Hostess is the definition of junk food. The whole point of these GLP-1s is they blunt your cravings. And it's cravings that drives sales of, donuts and ding-dongs and all the rest of the stuff. Plus, this class of drugs is still in its early innings. I don't think we'll discover that people lose interest in taking them. They're the most effective way to lose weight in history. I don't think there's any going back. But the packaged food companies keep telling us there's been no impact from these drugs. The liquor companies are adamant that they haven't been hurt, even though we know liquor consumption drops dramatically when you get these injections. The doctors very specifically put heavy drinkers on GLP-1s because they blunt your cravings for booze. They put those who can't resist junk food on these drugs because it gives them the willpower they never had. Yet almost every food or beverage company says they have data that shows GLP-1 drugs aren't impactful. I really want to see that data. Let's see it. I find it hard to believe that they can prove the glaring decline in junk food consumption comes down to the economy, which is the excuse they always use. I want to give these outfits the benefit of the doubt because Mars, a very smart company, just paid $36 billion in biggest snack food company acquisition in history, buying Kellanova. That's Pringles, Cheez-Its, Pop-Tarts, Rice Krispie Treats. But as I listen to Eli Lilly and I see its stock climbing toward the $1 trillion level, I think these junk food stocks are on the wrong side of history. I'm not inclined to buy the weakness in Smucker or any other food company that has hefty sales in snacks of any kind. Even if they really haven't been hurt by the GLP-1s yet, I think it's only a matter of time before they get hurt in the future. The denials are just too patent. Prescription growth is just too great to believe that these weight loss drugs won't end up as a deterrent to buying both junk food and then ultimately the food and beverage stocks of the companies that make it. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.